isn't in the other picture. Well, that's kind of what we're doing today. We're kind of trying to look at some little things here. A lot of things are the same. They don't go away, but we are going to look at a couple of things that have done, that have shifted a little bit that may suggest a difference in outlook on the market. Well, the first thing is that the debt focus, if you remember a few months ago, it was on Dubai, but now we have it focused more on what are known as the pigs, Portugal, Italy, Ireland, Greece, and Spain. Greece seems to be at the forefront of all that, and there's some questions about how they will come out of their problems, their economic problems with their deficit spending and so forth, and whether Germany will come to the rescue and so forth. So I don't know that anything has been officially decided, because if Germany does come to the rescue and save Greece, then there are other countries they have to worry about. That's kind of a negative in and of itself, the fact that they have to do that. So there are a lot of issues, I think, that in Europe that are a concern. Also, the Dubai situation, a lot of European banks were involved there. So a lot of concern, I think, a little bit more so than before about the debt situation, the bank situation in Europe. Also, the fact that Greece's debt manipulation has been associated with Goldman Sachs. Maybe that's a little scary. It's one of those things. Maybe I'm a little skeptical now, but it's hard to believe that anything Goldman Sachs does is for any good for the country or whatever, other than for Goldman Sachs. So what are they setting up? I don't know, but it's kind of one of those things that you have to keep an eye on. On the war front, the shift has pretty much gone from Iraq, that was the concentrated area in the past, but now it seems to be more centered on Afghanistan. Things seem to be turning a little more positive about the success of our efforts there. Of course, it doesn't mean total victory, because you have Yemen and Somalia and Iran and other hot spots that are still in the wings. So we just have no difference in what's happening. It's just that we have a little different location. Politically, I think that's one of the major changes that we have seen in the last few months, and that kind of revolves around the Scott Brown victory in Massachusetts, which kind of caused a turnabout. And then there were other announcements that have come out more recently about some prominent Democrats in Congress who have decided not to run again. So I think that now we are in a situation where that initial rush for health care and cap and trade and financial reforms and all the other legislation, that kind of a rush, panic type of situation has slowed down. I don't know if that's good for stocks, but it has alleviated some of the uncertainty surrounding the legislative situation. The stimulus programs are supposedly going to be wrapping up in some areas. Some types of the programs are going to be winding up in March on the home buying effort. The question here now, what will happen when programs to support housing or other stimulus efforts wind down? How will that affect the economy? And I don't think anybody can say that yet, because we've not been in that type of situation before. The gross domestic product, it has turned more positive. We'll get another update on what the fourth quarter said on February 26th, but right now the statistics show a 2.2% gain in GDP in the third quarter of 2009 and 5.7% in the fourth quarter. That's the best overall measure that we have of economic growth. And we have picked up now from the negative numbers from the earlier quarters and to the more positive numbers, although I would still say that the improvement seems to be agonizingly slow and on kind of a spot basis. There are some areas of the country that are suffering worse than others. It seems like the areas that have had the worst job losses have the worst housing markets, or maybe I should turn that around. The ones with the worst housing markets seem to have the worst job losses. So that's a local type of situation, but it's pretty widespread across the country. Now the question again, jobs. Where are the jobs? If the unemployment rate levels off around 10% or so, maybe we can say that the job cutbacks that we have experienced are not as bad as they were, but on the other hand, we're not picking up a lot of steam either. And unless there are more jobs, the economic outlook is not going to get much better for the foreclosure rates, consumer spending, some of the other key figures that the economists look at. On the investment front, the investment attitude, we don't have quite the panic type of situation, the hand-wringing for those people who have 401ks or IRAs or other investments in stocks or mutual funds. All you have to do now is look at the volatility index, the VIX, and see that it has dropped down into the low 20s again, and even below that level on several occasions in January. So unless there's a big down day, of course, then it spikes back up. But VIX is kind of calm. It indicates more of a complacent outlook towards what's happening in the stock market. The dollar, of course, continues to rise, and if some analysts are correct, it will continue to do so. Only a few months ago, in late November, the U.S. dollar index was slumping to the low 70s, and everybody was talking about the weakness in the dollar caused by the threat of higher hyperinflation and whatnot. But since then, the dollar has run up past 80, and it appears like it's not going to stop moving up a little bit. If it continues higher, that has significant implications for a lot of markets, including the stock indexes. Now, of course, we have a lot of information, and the question is, when you have all this kind of information rolling around, how do we use this information? How can we get a handle on it? How do we convert that to some kind of a money-making strategy that could work in our favor? Now, the problem is, of course, we don't know a lot of these big picture type of items. We don't know the politicians, what they're thinking and how they're going to act. And, even if we did know what would happen, we don't know how the markets would respond. Sometimes they seem to respond kind of perversely, whether they expect what to happen happens or whether it doesn't. So now we can't control any of those kinds of things, but we can control what we can do about the situation. And one way to meet the challenge of analyzing markets is to use Vantage Point intermarket analysis software. I want to make it clear I'm not the salesman for Vantage Point. This is not a product selling webcast or anything like that. I don't receive money for the product sold, but I like to look at where I can use some kind of indicators and tactics and so forth to develop trading strategies, and Vantage Point I have found to be one of the tools that has been helpful for that. Now, about the Vantage Point data, and some of the things that make it a little different from your typical analytical software, the Vantage Point data is based on intermarket analysis. A neural network process determines the 25 markets that have the most influence on a target market, and then it reflects the degree of that influence in a set of intermarket data that is different than your standard data feed that you might get. The price data for Vantage Point's predictive indicators come from typical prices, which is the average of the high, the low, and the close. When you look at most indicators in most analytical software, they use only the close. But computer analysis has determined that typical prices are more useful for a forecast because they do take into account the whole trading range for each day and not just that one price on the close. So you want to analyze the influence of other markets. The neural networks, by doing this, can forecast price direction a day or several days ahead, depending upon the length of the moving average or whatever indicator you are using, whatever the length of that is.